Hey guys, in the last video we covered the basics of how the repricing model works. We learned about what rate sensitive assets were and rate sensitive liabilities were, and we learned to calculate net interest income. In this video we'll be exploring more about what banks can do with their RSAs and RSLs to manage their interest rate risk. So just to recap from last video, rate sensitive assets just include your short-term assets and floating rate assets, and rate-sensitive liabilities include short-term liabilities and floating rate liabilities. And also remembering your two relationships between your gaps and interest rate changes. If you've got more rate-sensitive assets than rate-sensitive liabilities, you've got a positive gap, and that means you're exposed to a risk of interest rate decrease and vice versa. Now, we briefly went through these two relationships last video, and they're quite important, so I'll quickly go through how I personally like to remember these two relationships. For a positive gap, the bank needs to have more assets than liabilities. So I just think to myself, okay, so let's imagine a bank that only has one asset and no loans. And let's say that they have a short-term loan as their asset. That means borrower needs to pay the bank interest, right? So therefore, banks would prefer a higher interest rate since they'll be paid more interest by their borrower. In turn, it also means the bank is going to be exposed to a decrease in the interest rate. Now, also for a negative gap, it would just be the opposite relationship. But another way I like to think of it is imagining a bank that only has one liability and no assets. And let's say they only have one term deposit as their liability. The bank then needs to pay interest to their customer who owns that term deposit, and therefore would prefer interest rates to be lower, obviously, since they'd be able to pay less interest. This also means that the bank would be exposed to an increase in interest rates, right, if they have a negative gap. So that's personally how I like to remember the relationship between positive or negative gaps and interest rate changes. But obviously you can choose to remember however you want it to. But do keep these in mind, because to do the exercises we're about to go through, you need to understand exactly what rate-sensitive assets are and what rate-sensitive liabilities are, what positive and negative gaps mean, and what a bank is afraid of when they have those gaps. Now let's discuss how exactly a bank manages their interest rate risk. Banks can usually take action on whether to increase or reduce the amount of rate-sensitive assets or liabilities they have if they can speculate whether interest rates are going to go up or down. So in other words, they can restructure their assets and liabilities. If they think interest rates are going to go up, then they want to maintain a positive gap. And the more positive the gap is, the more net interest income they'll earn. And if they project a decrease in interest rate, then they'll maintain a negative gap. And obviously they also want it to be as negative as they can to earn a higher net interest income. Okay, so there are quite a few questions here, but each of these won't take too long. So let's go through it one by one. So the question says, if there is a negative gap in interest rate expected to rise, should a bank replace fixed rate loans with rate sensitive loans? Now, before we do any questions, we already know that we want a positive gap since the bank's projecting an increase in interest rate. So we want to get rid of rate sensitive liabilities and replace them with more rate sensitive assets. Because recall, if we have a positive gap, then to earn a higher net interest income, we want the gap to be wider or even more positive. Now in part one, you have two things. You have fixed rate loans, and you want to replace those with rate sensitive loans. So now you need to be able to classify whether these things are rate sensitive or non-rate sensitive. For a fixed rate loan, remembering that only floating rate loans are rate sensitive. So fixed rate means that its rate is locked. It's not going to change. So therefore it's not going to be affected by interest rate changes, right? So that means it's not a rate sensitive asset. Whereas for rate sensitive loans, that is obviously rate sensitive. So you're replacing non-rate sensitive assets with rate sensitive assets. Is that what you want? Yes, it is. Because doing so is going to make your positive gap even more positive. So just remember from this part, if you ever see something like fixed rate loan or fixed rate deposits, it's never going to be rate sensitive. If you see floating rate, it is rate sensitive. Moving on to part 2, should we replace marketable securities with fixed rate loans? So marketable securities are rate sensitive assets. They're usually short-term securities that can be liquidated to cash quickly. so they are rate sensitive assets. Fixed rate loans are obviously not rate sensitive because it's fixed rate, and so you're replacing rate sensitive assets with non-rate sensitive assets. And you don't want to do that, right? Because that's pretty much the opposite of what you're doing in part 1, except you want more rate sensitive assets. So the answer is no. Should we replace fixed rate CDs? CDs are certificate of deposits with rate sensitive CDs. Fixed rate CDs again is non-rate sensitive because it's a fixed rate thingy. Rate sensitive CDs are obviously rate sensitive. So you're replacing non-rate sensitive liabilities with rate sensitive liabilities. Is that what you want? The answer is no, because you're replacing non-rate sensitive liabilities with rate sensitive liabilities, but to maintain a positive gap, you want as less rate sensitive liabilities as you can. And bringing in more rate sensitive liabilities is not what you want. So that's why the answer is no. Should we replace equity with demand deposits? This is a bit of a tricky one because demand deposits usually aren't considered rate sensitive, but there is some controversy surrounding this topic. But for this cause, demand deposits do not count as rate sensitive because the interest paid on these deposits is practically zero and the rate doesn't fluctuate that much. So demand deposits aren't rate sensitive. Now, getting rid of equity doesn't affect rate sensitive assets or liabilities. If you've done accounting, you'll know assets, liabilities, and equity are 3 different sections on your balance sheet. So equity is not part of your assets nor liabilities. So getting rid of equity doesn't really affect anything here. And demand deposits aren't rate sensitive liabilities either. So it doesn't really change your, it doesn't really impact your bank's repricing gap. So there's no change. That's why the answer is also no. We only want to do something if it either increases our rate sensitive assets or decreases our rate sensitive liabilities. Alright, last part, should we replace vault cash with marketable securities? So cash is always non-rate sensitive. If you have cash, like if you have $1, it's always going to be $1. It's not going to be affected by interest rate changes. And recalling from part 2, marketable securities are rate sensitive because they are short-term assets. So here the answer is yes, because essentially you're swapping out non-rate sensitive assets with rate sensitive assets, and you do want more rate sensitive assets to increase your positive gap. So those are just a few examples of how banks can manage their interest rate risk. Main takeaway here is, if interest rates are expected to rise, banks will set a positive gap by increasing rate-sensitive assets and reducing rate-sensitive liabilities, and vice versa. So doing this will always result in an increase in net interest income.